I'm Ali Zendrian, Editor-in-Chief of Brand News, and this is the Financial Services News You Might Have Missed podcast. This is my opportunity to search through the news and try to find those gems that haven't gotten all their chance to sparkle. And fortunately, I brought my trusted financial advisor and co-host, Brandon Galisi, with me so that we could chat about all of those things. Brandon is of Galisi Financial. Brandon, thank you as always for doing this. I heard not fancy feelings this week, but there are feelings.
Yeah, there'll be some feelings this week, but probably not as many fancy ones as last week. Because last week, almost every single one was just a banger where I had thought very deeply about before you even had shown them or brought them to my attention. So all sorts of opinions and thoughts and feelings last week. So I definitely will still have some opinions and thoughts to maybe just won't be as fancy this week. Maybe it's slightly less passionate, but that's okay.
Yeah. So I don't know if anybody has ideas for what not fancy feelings, but feelings are. I take it that they're just feelings, but it feels like it needs to be slightly fancier than that.
Yeah, needs a name. Needs a different name. Yeah, let us know.
Yeah, please. Anyways, our first piece of news this week, it's coming from Seeking Alpha. They launched their Pro Quant portfolio this week. They're going to be delivering weekly stock ideas powered by the market-beating quantitative system that they have. This was designed for active investors who are seeking long-term capital appreciation. For those who are interested in possibly participating, this is for Seeking Alpha Pro subscribers. And you would get 2 to 3 new stock ideas each week. And the portfolio that this is a part of has 30 stocks in it at any given time. So when I saw this, I was interested by the new stock ideas. This seems like a very market picker, everybody who likes to day trade and whatnot. But curious how much this is helping things or hurting things, or look, there's all different flavors of investors out there and we have to serve all of them.
So real fun fact, I actually wrote a few articles for Seeking Alpha whenever I was still in school. So I chose a couple of individual stocks or individual companies while I was going through probably some of my investment courses and financial planning courses at West Liberty. And I'm going to put some of these to the test and I'm going to write. I wrote a few articles, and I think at least at the time you get maybe, I don't even know if it was a full penny for every single view. It was something about, it was views based or something. Got paid, again, we're talking very small amounts, but that was fun writing for them. Back to your original question though. So for the average investor, I don't think this is going to necessarily move the needle because I wouldn't even say just the average. Most people shouldn't be trying to do individual stock picking. But maybe if someone's an institutional manager or, they're running a model portfolio with a deeper expertise in active management, could potentially make sense. But again, I would say for the average consumer, I would not encourage you to pick individual stocks because there's just so much data that you alluded to, Ali, of picking individual stocks doesn't necessarily lead to outsized returns over the long run.
Yeah. Well, to your point, you hear this news and you might think like, gosh, this sounds great. But how do you sort of decide that you're a more active investor versus more passive? How do you know that this is a good deal for you versus just white noise?
You would have a deeper expertise. I mean, because if we're being honest with ourselves, I don't think a lot of people would say, oh, I'm an expert when it comes to the stock market, unless you've had some sort of formal training. You went to school for it, you're a CFA, or you work at a mutual fund company, or you have a background in investments, or maybe even more specifically equities. So if you're like, how do I know? If you're asking that question, you probably does not apply to you, because you can potentially, if you're picking individual stocks, you could have more risk in your portfolio. Is it aligned towards your goals? Now, all sorts of other questions come in, because at the end of the day, investing, obviously a very important part of the overall financial plan, but what are we investing for? Does this money need to be for retirement? Does this money need to be a bit more flexible, but it's still long-term focused? Is it for buying a house or a car in the next couple of years? So all of these things aren't necessarily going to get answered by simply picking stocks. It's like, oh, I beat an index. In my humble opinion, that's not a very good financial goal. Beating an index doesn't necessarily change your life in almost any meaningful way.
That is true. I guess other than whether you brag about that at like your Friday cocktail drinks or, whatever it is. Yeah, I guess probably not. You're right. Yeah.
No, that really would be it. Bragging rights. But I forget what book this was, but it told a story of someone was interviewing folks that had retired in a very kind of, I guess, bougie type of retirement community, something like that. And they asked a bunch of people, did you beat the market? Some said yes, some said no. Most probably didn't know. But then my favorite response, at least from this story, was, honestly, I don't know. I made enough to live here. At the end of the day, when it comes to our goals, most people probably can't tell you this is what I've returned over the lifetime of my investments, which is fine, but they saved consistently, invested consistently, and had good enough returns over the long run to afford retirement or their other goals. So again, if we can focus on what are we investing for, that's one of the first steps. And then we can start to figure out what types of investments make sense. And again, for most people, individual stock picking, unless it's a small play account and you're just doing it for fun, having your long-term money, serious money in a strategy like that you're picking, I would advise most people against that.
Got it. But so as far as the quants are concerned, so with the limited knowledge that I have, it seems like that's if you're going to put your money or your faith in anything, it's in the quants. So would you agree, or do you feel like you said, if your goal is really financial independence by the time that you're 60, does this achieve that or not? How should people be looking at that?
So I am a big fan of quant and quantified trading. And I think if someone is going to have a strategy, hopefully it's based on that and not just gut feeling or whatever else. I mean, maybe some sort of fundamental analysis, which would be looking at companies' financials. And that wouldn't maybe necessarily always be considered quant, but some level of serious research. So again, I think it's for the average investor not going to make as much sense. In this case, we'd still be back to the institution, where if you're an investor and you like true active management or proactive management, which even in my bias, I do like that. And I have even my personal investments in a more quant-based, probability-based portfolio for better risk-adjusted returns. And a lot of clients are invested in similar type of models. So I am overall a big fan of that type. It's just each situation is different. Each quant could be different. What are the expectations? What's the worst an investment could potentially do? We have to factor in our drawdowns and have all these proper expectations in place. So again, from an institutional perspective, or for folks that know what they're doing, could end up maybe being a good addition to some of their model portfolios. Again, but even then, what are we ultimately trying to accomplish? Are we trying to minimize downside risk? Just asking why instead of just, let me throw these in the portfolio. It's like, well, let's figure out why first.
Yeah. Very good point. Absolutely. So our next piece of news is Voya Financial is collaborating with Savi to give more student loan management option tools. So in this case, it has a dashboard with all of a person's loans and their total balance in one spot. There's also forgiveness eligibility detection as part of this. When I was thinking about this, fortunately, I just recently, within the last few years, paid off all of my student loans. But remembering which firm had which one and how I was going to access it and what the username and password was like a pain in the tush. And then add to that there is no way to quantify other than just going around and adding up the little bits. I think that I owe like 40,000 still. And this to me sounded like it would be super helpful.
Yeah, I agree. I mean, it seems like it streamlines everything, just aggregates all the information in one single place. So I'm a huge fan of simplicity and right, instead of having all these different logins for all of your different loans, having them in one portal where you can see everything, and even the forgiveness aspect that's built in, because there's been a lot of misconception around how the public student loan forgiveness, PSLF, even works. So if it at least has some information that it can provide people. And then, of course, if they want to talk to a human, they can also do that, but at least get a little bit more knowledge versus, is it even worth talking to someone about? Hopefully, it sounds like it's at least able to give you enough to know, I should probably explore this a bit further, or this actually is not applicable to me in any way. So I can, rest assured knowing that I'm not missing out on something.
Yeah, absolutely. And to your point about the forgiveness options. So again, I sort of wish that I had figured that out, at the same time, I'm very happy that I can say that I'm 40 and no longer have student loans. So that's pretty darn nice. But yeah, having somebody proactively telling me something like that versus me having to hunt around or hearing it on the news or whatnot, I was appreciative of.
Yeah, absolutely. And I think another thing that stood out in the article too was a quote that said 42% of employees are more likely to stay with their employer if offered assistance to pay off their student loan debt. So that was in regards to the Secure Act 2.0, where employers are able to do student loan matching instead of a 401k match. And I think which you had brought up on the show before, but I think we had both agreed then, or at least me, I expect that to be more of a popular item moving forward, where if someone's going to get a 4% match, for example, whether it goes into investments or student loans, they're still going to be able to take advantage of that match money. And for some, it might make more sense depending on what their student loan debt situation is. So I think we're going to continue to see growth in this particular space. So a lot of good things happening, I think, in the student loan avenue.
Yeah. So to your point about how you decide whether you want to put it in your retirement bucket or in your student loan bucket, I take it would probably depend on what the rate is on your student loan and how much that's crushing you versus you saying, yeah, you know what, I'll save for a rainy retirement day later. Or how do you, as an individual, make that decision?
So that's one. So you can see what interest rates are. So that would be we'll call it the sheer mathematical version. If you have a higher interest rate on your debt than you expect to earn in your investments, well, then you would pay off the debt. So that's the sheer mathematical approach, but also bringing in the emotional side to it as well. That's understanding what's important to you, because maybe getting rid of this student loan is going to provide you a massive psychological benefit, which would then improve your overall quality of life. And then you could start investing that match, if you will, above and beyond. Because again, at least if we're talking about this example of where would I want my match to go, to my student loans or towards my 401k, well, given in that assumption, you are already at least contributing, again, we'll use this 4% number, you're already at least contributing 4% to your retirement. And then the other 4% would be going towards your student loans. So that could even allow someone to do a mixture of the two. Because if you Google, should I pay off my loans or should I invest? You're going to get a range of answers. And unfortunately, there's not one right one necessarily. Sometimes it's more obvious where if you have, 25% credit card debt, or should you invest in a brokerage account and get, 7 to 12% a year? Like, okay, well, that one's a bit more obvious. That's a credit card, but student loans typically have lower payments or lower interest rates, at least in that. So yeah, you just have to figure out the emotional side, how that's going to impact quality of life, and also understand the numbers as well. And potentially it could be in the middle. It could be a balance of the two.
Yeah. That was a very nice and I think well thought out, it depends, but so I'm glad that you did not say it depends.
Yeah, right. Well, no, I agree, because so much in the industry, it depends, which is true, but then there's no framework. So what I try to do, even in giving advice like this, when it truly does depend, is the hierarchy answer. Here's a framework to think about it. Maybe you grew up and you saw your parents struggle massively with debt. So in your mind, being debt free is priority numero uno. Well, even if it doesn't necessarily mathematically make sense, now, if I'm advising someone and I see that this is going to blow up their financial plan or something like that, I would step in and be like, I understand this, but here's a bad situation that could happen if you do this. But as long as it's not going to do that, even if it's suboptimal from a mathematical perspective, in that case, it might make more sense for that person. So I always try to think in these frameworks of, here's some ideas on when you might want to pay off debt first. Here's some other situations that you might not want to pay off debt first and instead invest. And then, of course, if I'm having a one-to-one, that makes it easier. But even if I'm not having a one-to-one, hopefully that's given someone some guardrails or some things to think about so that they can make the best decision for them versus just, it depends. It depends as a cop-out if you don't follow it up with anything else.
Yeah.
There's my fancy feeling of the day.
That was a fancy feeling. See, it made its way in. Well, I appreciate that, and I appreciate the fact that you do give in-depth answers instead of just no or yes or it depends. So thank you for always doing that on the podcast.
Yeah, I try. Again, that's how I even think about my content, because it's just, again, it's so annoying. I know it depends, but give at least a little bit of color, some direction that someone can think about. How can they apply it? Because that's the huge issue I see so much too with just the influencer space, even on the financial side. It's just, here's one way to do this. I'm like, that's not the case. Like, personal finance is personal. Saying there's one blueprint to do it, are there great principles? Absolutely. But one way for every person, I don't think it takes a rocket scientist to figure out that's probably not correct.
Yes. Absolutely. Well, so getting to our third piece. So Nicholas Wealth has launched the Nicholas Crypto Income ETF, which is actively managed with diversified exposure to the crypto ecosystem overall. So one of the features of this is that it generates potential income via proprietary options overlay. So what's interesting about this, there are multiple sleeves of this. The first sleeve is investing in stocks related to different parts of the crypto economy. So that could be mining, it could be blockchain, other things. The second sleeve has direct exposure to Bitcoin and Ether itself. And then after that, they're selling puts spreads on crypto sleeves and selectively writing covered calls or put spreads on the stock holdings themselves. Obviously, that's a lot of investment terminology altogether, only some of which I truly understand. So curious what you think about this kind of crypto exposure. Is this a way to look, if you want to dip your toe in, this is helpful to have so many different ways to do this, and it sounds relatively risk adjusted? Or at some point, is it look, a thing on top of a thing on top of a thing? What even is this?
Short answer, I don't know. I know the words that you were saying. I haven't looked into specifically this product. I think a lot of times too, if something starts to sound very, very complex, especially then, there needs to be a very distinct, back to what we talked about earlier, a very distinct why or purpose. So by no stretch am I saying that this couldn't have a place in someone's portfolio. But the question with any investment, not just one that's a bit more complicated, of you're like a sleeve on top of a sleeve, there's this option strategy, there's a put strategy over here, there's also for income, there's some stocks, there's some crypto. It's like a lot of, even we'll call it just jargon involved. And with that, what's the overall purpose? What are we trying to accomplish? And then after we know what we are trying to accomplish, what's the best product or best solution? Maybe there could be cases, and again, I'm not an expert on this particular product, but I'm sure there are some cases that this is going to be a great fit for clients. But just like we just talked about, there's not going to be a one size fits all approach for a lot of people. If you're looking for simplicity, if you're optimizing for simplicity, maybe not something like this. But at the same time, depending on what you're trying to do, could potentially make sense. That's at least my answer without knowing tons and tons about this particular.
Yeah, absolutely. And that's totally fair because, as I mentioned, it's got a lot going on. Do you feel like then with this kind of strategy, it seems like it's not really for like the average retail investor, because how am I remember puts and calls back from my first reporting days, but like beyond that, who is this made for then, do you think?
That's a good question. As I was reading through, I was even trying to see that. I think one of the things that they even said in their article was maybe for a more risk averse client who wants some exposure to crypto, but also maybe some income. But even there, you could almost make the argument, why not just have a 1%, 2% allocation to crypto and then have your fixed income or dividend funds to provide that income, or even a normal covered call type strategy on a stock for some of that income. So even there, I think this is a super niche, super nuanced product where I don't have a perfect answer here, but there's at least one potential idea. I'm always going to send this back to what is it accomplishing? And maybe, like we talked about, this is almost a social job to be done, where you just want to talk to your friends at that cocktail party about this cool investment that you have in your portfolio. Even if it's a really small allocation, I'm going to sound super smart talking to my buddies. Look what my advisor put me in. And, could serve as a social job. Not that that's why you should make an investment, to be fully clear, but I could see that being an aspect, because we're not, as much as we think we are not rational human beings a lot of the time. So sometimes the emotional jobs or social jobs might be a reason that we do something like this.
Yeah. I'm just thinking out loud, but if you are doing this for the cocktail party reason, I would hope that then you understand each of the portions of this, because I can imagine me being the type who would like go in braggadocious, like, oh my God, do you know what I just did? And then someone asked me a follow-up question and, deer in headlights, have no idea, but, had that like 5 seconds of, I did this cool thing. Just saying.
Right. Yeah. You got to be prepared for questions. If you're going to brag about it, you got to be ready to answer. Like, the simple question is going to be, what does that even mean? So question number 1.
Exactly. Anyways, our last piece of news. So Rapid Finance is using AI to cut its loan application processing time. It's taking it from 20 minutes down to 20 seconds. It's SPADE, which is smart processing and data extraction, uses advanced machine learning to get data from inconsistent and handwritten loan applications in PDFs. As I was thinking about this, initially my thought was like, 20 minutes to 20 seconds. This isn't like hours to seconds, but also as a small business owner, if you could tell me in 20 seconds that I've got somewhere something, or I don't, and then give me the next opportunity to move along and figure out what other strategy I may have, that would be helpful.
Right. We've talked a lot on the podcast about efficiency. And I feel like it's actually been a while since we have an AI kind of data gathering tool like this, although we have talked about them before. But so I think this probably more so from more on the back end, because as a business owner, you likely don't need to get a business loan funded the exact same day, or unless you are in some sort of crazy loan shark scenario, which you've probably got bigger problems than 20 seconds versus 20 minutes. But I could see from the back end or from the business's perspective that's sending out these loans, or other companies that might now utilize this product, they're the ones that are going to see some massive efficiency gains. And who knows if any of those efficiency gains could trickle down to the end consumer, where now if they have it costs less to issue loans, well, maybe there's some more promo rates where they can offer a slightly discounted rate because the labor involved up front is a little bit less. Now, again, I'm not saying that for sure would happen, but if nothing else, efficiency gains from the business that's offering these loans is 20 seconds instead of 20 minutes is pretty huge for them.
Yeah, that's true. And just shouting out to any of these loan people. So if you could lower the rate as a result of not needing to be as work intensive and whatnot, any of us on the other side of things would really appreciate that. Just saying. This also reminded me though, so Quick. So I don't know if you've used their forms, but so Rich Walker has been a fabulous podcasting friend that I've had. His company, Quick, so they're data gathering from forms and standardizing that whole process. So the company's form extract uses OCR and AI along with human validation to try to streamline that whole process. So it's great to know that, these paper forms that are like, yeah, and check the box and do it like 15 times over and like initial at the bottom, and like, this is not the world anymore.
Right. And hopefully doctors' offices and medical offices start adopting any of this technology, because anytime I think of even what you just said, like where you have to check the same box or enter in the same information like 7 times, you already have my birthday. Why do I need to manually write this birthday out for the 6th time? Like, what are we doing here? So hopefully I'll take a small shot at medical practices. They can streamline some of their processes so you don't have to sit in the waiting room for so long filling out the same information you have the last 7 times you went to said doctor's office. So anytime I think of what do I want an onboarding process to be like from an efficiency perspective, I'm like, what does a medical practice do? Okay, the opposite of that. That's what I want. Now, again, I'm sure there's some medical practices out there that are crushing it that are not like that, but the stereotypical ones that I've been to have unfortunately been all those forms.
No, it's so true. I mean, when they have like the 4 different forms, and you're right. I guess in their defense, they're sending it to 4 different places, but it's still is there a reason that this can't be on an iPad so that we can just standardize this to begin with and make it a digital experience? And B, to your point, like, can't we just share this data across people instead of saying you over here in billing and you over here as the provider, and let's just all talk to each other.
Right. Or even if you still have to do a manual form, it's okay. What's all the information that you're going to need across those 4 forms? Okay, great. Have one single standardized form. I agree, an iPad would definitely be better, but let's say we're still in the old age here. We still have a paper form, but we have one form, fill out all of the pertinent information. Then that could get scanned in, and then that could get disseminated to the 4 different places that it needs to go. So I feel like there's all sorts of solutions to the problem, but also I guess with medical, it's like, what are you going to do? Leave when you have a doctor's appointment because the process stinks? No, you're already there. Probably not. You're just going to complain about it like the rest of us.
It is true. I mean, we do need them so badly that we just put up with all of it, but yes. It would be nice if there was more efficiency. Yeah.
So again, I think there's going to be all sorts of tools coming to market that will help with efficiency, things like this. And even from your and I's end, from like even DocuSign is something that I use, and these other tools that really streamline the process compared to, again, traditional paper. Like, I'm not sending out any traditional paper forms. Like, I have not got a wet ink signature from a client. I don't think my entire time of having my practice, nothing has been wet signed. I don't think. Pretty sure.
Yeah, I haven't done it. I hope that's true of all of your other clients, and I'm glad that that's the case. May it stay that way.
Right, absolutely. I'm definitely not going the other way, because I work with people from across the country, similar to you. I'm not going to send a packet in the mail. God forbid one checkbox doesn't get ticked. Let me mail it back. So efficiency, less paper for the.
Heck yeah. And that was a slightly fancy feeling. I'm just going to put that out there. I mean, not full fancy, but like getting there on the fancy.
Yeah, slightly bougie. That was a slightly bougie feeling. It was on the track towards bouginess.
Yes. Anyway, thank you as always for doing this, and for taking so much of your own time to explain these things and explain them incredibly well. So I appreciate it.
Awesome. Well, happy to be here. This was fun as always, Allie.
Thank you.